Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for Financial Literacy Month, which of course takes place every April, is Seth Wunder, Chief Investment Officer at Acorns. Seth, it's great to see you as always. Welcome back to Trade Talks.
Yeah, thanks for having me.
You got it. What is the most important thing investors can do when it comes to banking and investing?
Yeah, let me start with the investing side of it first. The key for investing is to have two mindsets. One is to think about investing over the long term. The idea that compounding returns benefit you the longer in the market is just math and proven over 100 years worth of investing. And the second one really centers around being diversified. There's that old proverb of don't put all your eggs in one basket. That didn't just come about in the last banking crisis. I mean, that's hundreds of years worth of knowledge. And that's true for investing, making sure that you have, whether it be stocks and bonds, or if you want all stocks, but having multiple different investments. And in that regard, it gives you more chances to win, but it also offsets the risk of loss because you don't have too much concentration in any one specific investment. When it comes to banking, I think within banking, the thing is if you have multiple banking institutions, that's great. If not, you obviously should just be aware of where the FDIC insurance is for your bank, so up to $250,000. But also to be wary of gimmicks that what banks use to try to get your deposits, like APY and other things along those lines, and just to make sure that you're conservative in who you bank with.
What about market timing? The recent news that we've seen in February and March, particularly around Fed policy and what's happening with the banking system, is it making some investors nervous?
I'm sure it is, but when it comes to market timing, I mean, this is a fascinating lesson that I've learned, and it's important for everyone to understand. When you look at the last, let's say, 100 years of stock market returns, if you reinvest your dividends, the stock market averages about 9.5%. But in any one year, the chances of the stock market being up 9.5% has only been less than 10% of the time, right? So every year is going to be a little bit something different. And if you think about since the beginning of 2020, right as COVID started, I mean, the market since that period of time has had two amazing years and one not so great year. In fact, there's been two bear markets over that period of time. And yet over the whole 3 years period, the market's up pretty much almost exactly 9.5%. And so, not many people could predict every wiggle and waggle over the last 3 years, but with the benefit of time, you would have returned similar to the long-term average. So it's probably not worth the distraction to try to figure it out, knowing that the probability is you're going to get it wrong, whereas over the long term, take advantage of the averages.
There was a narrative in the market up until late to mid 2022 that the 60-40 portfolio was dead. Explain to the audience what that is and why 60-40 portfolios are back in action.
Okay, so what that refers to is what percentage of your portfolio is invested in bonds and what percentage is invested in stocks or equities. And so it goes back to the power or the importance of diversification. Historically speaking, bond prices and stock prices have moved in opposite directions. And so you have a little bit of yield and a little bit of opportunity on bond prices, and then conversely you have growth when it comes to stocks or equities. There was a multi-year period of time where interest rates were zero. And so when interest rates are zero, you really don't benefit from bond interest. And for those who don't understand bond math, when rates go up, bond prices go down. And so when interest rates are zero, you're not getting any interest return. And you also have the risk that bond prices can come down when interest rates go up. We saw that in 2022. And so there was this building narrative of that the 60-40 portfolio is dead because bonds were hurting your portfolio, both in terms of no interest and the prices going down. Well, now interest rates have normalized. We have 4.5% interest, which is somewhat in line with the long-term average. And for decades, we've had interest rates at these levels. And so now you have the appropriate amount of opportunity in bonds, both between bond price and interest. And stocks continue to have the same opportunity they've had over the long term. And so you actually have a really good, healthy balance of both in the bond market and in the stock market. And so that allows for that 60-40 portfolio to really make a lot of sense. And if you were to look at the long-term history and think about those trends in the future, you would say that the 60-40 portfolio sort of dead speak was really just a moment in time, and with a longer-term time horizon, where we're at today should look, I think, appropriately more like history.
All right, Seth, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.